Most investors chase yield until they find themselves missing out on growth. Today, we're putting two ETFs head-to-head: JEPQ, the high-income powerhouse, and VOO, the ultra-low-cost growth engine. But what many investors don't realize until it's too late is how radically different their paths can be. By the end of this video, you'll understand what JEPQ and VOO really give you, what they take away, and why most investors don't realize the truth until it's too late. Let's begin with what these ETFs fundamentally are. VOO, the Vanguard S&P 500 ETF, is the poster child for passive investing. Ultra-low cost, diversified exposure to 500 of the largest U.S. companies, and a long track record of performance. As of early August 2025, VOO's expense ratio stands at a mere 0.03%, and its dividend yield is around 1.17%. JEPQ, on the other hand, is JP Morgan's Nasdaq Equity Premium Income ETF, a covered call vehicle that focuses on Nasdaq 100 tech stocks while generating income through selling call options. Its expense ratio is significantly higher, around 0.35%, and yet it pays investors an unusually high dividend yield of over 11% per year. That high yield is seductive. Imagine getting double-digit payouts while still participating in tech stock exposure. But what's not obvious at first glance is how that income is generated, and at what cost. JEPQ sells call options on its holdings, which brings in premium income, but simultaneously caps upside when markets soar. As a result, this strategy can soften losses during downturns, but it also means giving up significant gains in bull markets. Let's put some numbers to that. Over the past 12 months, JEPQ's total return, price plus reinvested dividends, has been approximately 16.25%. VOO's trailing 12-month return sits slightly higher at 16.67%. So in the recent past, JEPQ has performed in line with VOO. But look closer. In 2023, JEPQ delivered a dazzling return of 36.26%, outpacing many peers. Yet, VOO was strong too, with returns in the mid-20% range, still solid, but behind JEPQ that year. Fast forward to 2024, and both funds again posted similar gains. JEPQ around 24.8% and VOO 24.9%. But the real test comes during volatile periods. In 2022 and 2023, during a sharp downturn and rebound, JEPQ demonstrated its covered call mechanics in action. It declined less than broader indexes during the sell-off, showing smoother performance when markets dropped, covered call strategy providing downside cushioning. However, when markets surged again, JEPQ lagged behind because its call options capped upside gains. Exactly the trade-off. Some protection in the downturn, but forfeited growth during the upswing. Here's the crux. What investors often don't realize is that high-yield funds like JEPQ can underperform in rising markets, precisely when they feel safest. The income cushions losses, but leaves you stranded when markets surge. Meanwhile, VOO offers lower yield but full upside participation, matched with rock-bottom costs and diversification. Now let's look at risk. Volatility for JEPQ has shown to be slightly lower than VOO. JEPQ at 3.21% versus VOO's 3.39%. That sounds attractive, yes, but those numbers reflect short-term fluctuations, not the larger strategy trade-off. What you gain in steadiness, you may lose in growth. Another drawback is taxes. The income JEPQ pays comes mostly from selling options, and that's usually taxed like regular salary income. By contrast, most of VOO's dividends qualify for lower tax rates. This difference might not sound big, but for people in higher tax brackets, it can quietly eat away a noticeable part of their returns. Let me bring it back in simple terms. JEPQ gives you income today, often more than 11% annually, and it can shield against small downturns. But if the market runs, you'll pay for that protection with missed gains. VOO gives you less today, around 1.2% yield, but full ride in market rallies and negligible fees. Cost is tiny, growth potential is full. Over decades, that matters deeply. Real-world data backs this up. Over 3-year periods, VOO exhibits a KGR of about 16.22% versus JEPQ 16.09%. Not a staggering gap, but compounding makes small differences matter. And remember, in extended bull markets, that small margin grows into a large one. The income advantage of JEPQ might feel great quarterly, but long-term, VOO's compounding edge is subtle and powerful. The lesson here? Investors must recognize that JEPQ isn't simply high-yield Nasdaq exposure. It's exposure plus an options overlay that actively reshapes return patterns. If you're genuinely income-focused, understand that you're sacrificing some performance for current cash. If you're growth-oriented, you might prefer VOO's pure indexing with far lower cost and full upside. All this matters urgently, especially now as markets remain uncertain. If your financial plan overly weights high-yield income without accounting for loss of growth, you may wake up one day realizing your retirement nest egg is smaller than it should be. Too late to adjust without cost. So, what's the final takeaway? Use JEPQ if you need consistent monthly income and can weather underperformance during rallies. Choose VOO if your priority is long-term compounding, low fees, and full equity exposure. But don't pick blindly, know the mechanics, because what you don't realize today could cost you dearly tomorrow. This has been Finance FlowChart, helping you navigate the pathways to smarter investing and long-term financial freedom. Don't forget to check the description section for all the reference links to the data and documents used in this research. And remember, this video is for educational purposes only and should not be taken as financial advice. Always do your own research or consult with a licensed professional before making investment decisions. If you found value here, make sure to subscribe to Finance FlowChart for more smart comparisons and insights into the world of investing.